Hello, Dividend King subscribers. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and one of the founding partners here of the Dividend Kings Marketplace service. And you know, we're coming to the end of the year, and boy, it's an end that I sure can't wait for it to be over. But having said that, everyone knows what I mean. You know, I do think it's a good time to reflect and talk a little bit about the market and what the market's done. So, you know, I'm getting a lot of questions from people and clients, individual investors, subscribers to FastGraphs, as well as Dividend King subscribers, talking about the fact that since I'm known as Mr. Valuation, you know, value stocks, the market's at an all-time high, but value stocks really aren't performing. Has value dead? Has value lost its allure? Well, bottom line is, as I mentioned in the written portion, you know, tech is dominating the market right now. And it's one sector out of 11 sectors that's really been generating the majority of the returns that you see in the market. So let's analyze that a little bit. I'm going to cover a lot of stocks in this video, so I'm going to go quickly. Let's start with the general quote-unquote market, the S&P 500. What you have here on the orange line here, these are the earnings per share plotted. The white line are dividends for those of you not familiar with FastGraph. The orange line represents a 15 PE ratio, which I would consider a rational valuation. That's an earnings yield of about 6.67%. That's really the minimum return that I would expect. So I want to see the price when I bring it on the graph here at or below this orange line for me to call it in value. The blue line is a PE of 17.5, and that range between 15 and 17 is very close to a 200-year average, you know, valuation multiple that has been applied to the market historically. And again, there are rational reasons for this. But here's the point. When I put price on the graph, these are monthly closing stock prices. First thing I want you to notice is that most of the time, the price correlates and tracks somewhere, you know, around or within these two lines, the orange line and the blue line, which are valuation references. During the Great Recession, we had a real bargain in the market, although many of us didn't see it at the time. During the irrational exuberant period / tech bubble, we had some really excessive valuations in the market. And you can see high valuations typically lead to poor performance, and low valuations typically lead to great performance. So when we look at the market today, we've got a blended PE of 26.7. The normal PE has been 17.5, and a fair value would be 15. So we've got a market that's almost 100% overvalued based on what I would consider to be intrinsic value. But here's the point. That is really a misnomer because it's being dominated by just one sector, and that's the tech sector. So let's look at some of the top 5 stocks, actually 6 if you count Google twice, Alphabet twice, you know, Google and then Alphabet, A and C shares. So let me go through these and show you. Some of the top tech stocks are actually attractively valued, but they are selling at very, very high multiples, even higher than the overall market. And I'll explain that as I go here because that's very important. So the first one is Apple. One of my favorite companies in the world, you know, $2.1 trillion market cap. I mean, how can you not love Apple? Well, I do love Apple, and I continue to love Apple. Company's grown earnings at over 17% a year. You know, historically, a company's forecast, even with a $2 trillion market cap, to grow at 11% over the next several years. The longer-term trend line growth rate is 12%. That's double-digit growth rates for a $2 trillion company. But alas, we have this stock trading at over 37 times earnings. Extremely high valuation for this stock. It definitely has momentum. It's had it for the last 2 years. Otherwise, you see this stock again tracking this orange and blue line with different values. Here we have a 13.6 PE for the blue line and a 17.17 P equals growth rate or PEG ratio of 1 for the orange line. And clearly, Apple is overvalued, and it's dominating. It's one of the dominant companies in the market, as I indicated, you know, in the written portion. The next company we want to look at is Amazon. Now with Amazon, this isn't about profits, this is about cash flows. So here's Amazon looked at through the lens of operating cash flow on FastGraphs. And you can see their operating cash flow growth has exceeded 30% a year, 34% a year to be precise. So the orange line is a priced operating cash flow of 34. That's what I would call fair value. The blue line is a price to cash flow of about 26.6, or we'll call it 27. So obviously the more conservative valuation would be the blue line. You notice that Amazon is right in the middle. Bottom line is, for the amount of growth that this company is expected to have, the stock is attractively valued, but it is actually selling at a PE ratio higher than the S&P 500, if you recall. Just look at that real quickly. The S&P 500 is trading about 27 times earnings with an average growth of just under 6%. And then we go to Amazon, that's trading at a 30 multiple, much higher, or certainly higher, but it's growing at 35%. When we look at the future, Amazon is expected to grow over the next cash flows now over the next 3 to 5 years at over 38%. That would indicate that the stock is very undervalued. For the next couple of years at least, it might be closer to 24%, but it would still be well within the valuation corridor. So I consider Amazon attractively valued, but it does have a high multiple, and it is contributing to the high valuation of the market. It's a very large percentage, as I indicated. And I'll show you a little more of that here in a moment. And then you get to Microsoft. Microsoft has been a 10% grower, 10.68%. They've got a great story. You could have bought Microsoft, I want to remind investors, at single-digit multiples, 9.98, we'll call it 10 multiples back in 2013. Now, the company's growth has accelerated. You can see that by the slope of the orange line and the numbers here. The growth rates have increased dramatically over the last several years. So growth now is averaging over 13%. Once again, we have a $1.6 trillion company. If I look at forecasting, it's expected to grow at 15%, which is phenomenal. If I look at it longer term, it's the 3 to 5 year growth is over 12%, which is phenomenal. But alas, those numbers do not justify this high valuation. There's a lot of risk in these top 5 tech stocks, in my opinion, at least with Microsoft and Apple, as I've indicated so far. Moving on to Alphabet. Now, Alphabet's an enigma. I want you to get a couple of lessons here on valuation. Google, as most of us know it by, has grown earnings at over 36% a year historically. You can see that the price now, the PE of the blue line here is 31 times earnings. P equals growth rate again. The normal PE, that's the normal PE. The growth rate has been 36.12%. So P equals growth rate's the orange line, and it actually looks inexpensive here. But I want you to notice something here. If I drop this off to 18 years, just knock a couple of years off, all of a sudden the growth rate's now 28.9. This behemoth, $1.1 trillion market cap is beginning to slow down in its growth. If I drop it to 15, the growth rate drops down to 17%. Now I'm drawing the PE at a PE equal to growth rate of 17%. Now we're starting to see an extended or high valuation. If I drop it even slower, it's 13%. So what's happening is Google, Alphabet is actually very, very inexpensive if you're looking at future growth. This company, long-term trend line is expected to grow at 15%. That's phenomenal. The more normal growth rates for the more near times is about 13.7%. These are great numbers for these great companies, but the point is these stocks are trading at extremely high valuations relative to what their earnings capabilities are going to be. Even with forward earnings, these stocks are still expensive. Google and Microsoft and Apple. Then, of course, Facebook's been a 34% grower. P equals growth rate, 34 times earnings would indicate that it's moderately undervalued here. If I look at forecasting, it's forecast to grow at 22% over the next couple of years, longer term at 24%. So even though Facebook is very, very highly valued, this would be a stock that could generate double-digit returns over the next 4 or 5 years if it actually meets these growth expectations. And of course, that's a big if. But the bottom line is the stock is certainly not cheap. Now, what I want to do then is leave this. These are the stocks that are dominating. They represent almost 30% of the entire market value of this thing we call the S&P 500. Those 5 stocks are dominating this market. So let's look beyond that. Let's look at some of the Dividend Kings top buy lists. And this is what I mean by a bifurcated market, and it's a market of stocks. Here you've got BristolMyers trading at less than 10 times earnings. By the way, forecast to grow at almost a 15% rate in its own right, which indicates, very strong double-digit, ridiculously high, 27, 28, rates of return over the next 3 to 5 years. The long-term growth rate is expected to be around 10. That would still give us double-digit rates of return. Mind your owned businesses. This is a stock that's extremely inexpensive, has a high dividend yield, it's A+ rated, and it's certainly a lot different than what we saw with the market. Going down the line to another company in the healthcare sector. Healthcare and financials are 2 sectors that are ridiculously cheap and not been participating in the market. You've got Cardinal Health at a 9, multiple again of almost a 3.6% dividend yield. Forecast growth going forward is about 6% long term. Over the next couple of years, about 6% again. But if this just gets back to a more normal PE ratio, there's enormous what I call natural leverage opportunities here. If this thing gets to a more normal multiple, even its normal multiple of 12, which is lower than my 15, would still indicate double-digit rates of return. I don't see anything really stopping Cardinal Health from getting there. If I go on, if I look at General Dynamics, which I've recently written articles about, as well as Cardinal Health, as well as BristolMyers, by the way, once again, you see now a 13 PE at over 7% earnings yield, just like it was coming out of the Great Recession. This is a great time to be looking at General Dynamics. Even if I use the normal valuation of 16, I've got very high double-digit rates of return expected for this company. The longer-term growth is expected to be a little more muted at about 4%, but that still gives me double-digit returns. It's a market of stocks, not a stock market. I think General Dynamics is an excellent choice. A-rated, 37% debt going forward. And then, of course, the tobacco, which I'm on record of saying in the past I'm not a fan, but it's a highly recommended Dividend King stock. It has an 8% dividend yield. It's very, very inexpensive relative to its earnings growth. Forecast earnings going forward are going to be relatively muted, about 3.75%, near term, about 4.8%. But you put any kind of rational multiple of earnings on this, and you've got some really attractive total return numbers. And of course, with an 8% dividend yield, pay you while you wait. And if you look at the stock historically, it's always traded around that 14 or 15 PE. In other words, it's not uncommon for it to get to a 15 multiple. I see no reason why it won't there. It wasn't only a couple of years ago you would have been buying it at a 22 or 23 multiple. I want to remind you that the demand for this stock was very, very high there, just as you see with some of those tech stocks I showed you before. Reality set in, if you will. As Dividend Sensei says, in the long run, fundamental generate 93%, I think it is, of the rate of return. And then finally, last but not least, we have another financial, Prudential here. When you look at Prudential, you can see that the stock is very, very inexpensive. It traded at a 15 PE coming into the Great Recession, which was financial, instigated. Since then, I do want you to point out, it's been trading at about a 9 or 10 multiple. So if I'm looking at this stock, I like to look at it at these lower multiples. But even then, you've got this incredible rate of return potential. Even if I pick a 9 multiple, I've got 20% plus rates of return. But there's also reason to believe that this stock will eventually move back into alignment with a 15 PE, and then I have some really incredible returns. And I've got a 5.67% for an A-rated company with 21% debt, dividend payment, with a great long-term record of increasing their dividend by over 10% a year. So, mind your own businesses. It's a market of stocks, not a stock market. The last thing I want to end this video with, that's the 10 stocks. All I'm doing is contrasting that one sector, the tech sector, that's so highly valued with other sectors that are more reasonably valued. But I did come across this chart by a company called Slick Charts, and what I wanted you to see here is the weightings that I had listed in the written portion. Apple is 6.7% of the weighting of the entire S&P. Microsoft 5.4, Amazon 4.5, we'll call it. Facebook 2.1. Alphabet, if you combine the two alphabets, the Class A and the Class C, it's about 3.4%. Berkshire's 1%. But watch what happens as you go down the food chain here. As you go down into the 100th stock, you start getting into numbers where you're looking at Chubb Limited, another financial, at 0.22. In other words, 0.2% of the market. You go even deeper into the couple of hundreds, you start getting into single digit, 0.09%. You get down here even lower, you get 0.06%. You go out even lower and you get down into minuscule positions. You've got some really well-known companies, by the way, in some of these, some of these areas here at these very, very low valuations. Advanced Auto Parts at 0.0. 0.03%. I mean, it's just, the difference between these and the tech stocks. So you can see a lot of these stocks are very, very inexpensive, and they're trading at very low valuations, but they represent such a minuscule part of this thing called the S&P 500 that they really don't play much into the scheme of things here. So when you're looking at the overall market right now and talking about how great it's done, I want you to recognize and remember what we've seen in this video. It's a market of stocks, not a stock market. There's only 5 or 10 stocks, probably the top 20 stocks really dominate this valuation. Otherwise, you've got an awful lot of stocks here that are trading at very, very attractive valuation. I guess a lot like Prudential here and BristolMyers and so on and so forth. So, this has been Chuck Harmos. I hope you enjoyed this. I'm not going to be posting a video or an article next week. It'll be Christmas. I wish everybody a Merry Christmas. Happy holidays if you prefer that. I'm a Christian. I call it Merry Christmas. I really appreciate everybody, and I hope we come out of this 2020 and get into 2021 with a brighter future and a much brighter new year. The market's been good, but not the whole market, just parts of the market. Thanks for watching. Subscribe to my YouTube channel if you like what you see here. And again, Merry Christmas, everybody.